Okay, this is Brent from TradeGuild.blogspot.com. I'm back with the part 3 of our little video series here. We looked at T2115, and now we're going to look at the next Warden indicator. This is T2111, and I just love these indicators. I think they're really, really great indicators for looking at the market and where the market's at right now. Let's zoom out a bit here, and I hope you can see that. But we're looking at the indicator in green, and this is percentage of stocks on the New York Stock Exchange trading two channels above their 200-day price moving average, and in red we have the spiders, the ETF for the S&P 500. So you can see really this number has been on a steady trend down as we've been going up, and that's a little bit typical as market starts to mature. But if we look at it a little bit closer, we can see their 200-day price moving average has gone from about 5% back here in September. It ran up to about 20% in the beginning of November, and now we're back down to 11. Now, this 5% or so was back here in August when we had that pretty steep correction related to the housing problems. We do have a lot more downside, I think, before we even approach an oversold level. So we'll see about that. Next indicator is Warden Series T2108, and this is a great one. I love this. This is percentage of New York Stock Exchange stocks trading above their 40-day simple moving average or price moving average. Again, a lot of people are in positions that are a loss right now. And how do we know this? Because these are stocks that were trading above their 40-day moving average. Back here in October, we had I don't know, looks like 80%, and now we're down to 25%. So a lot of people were in stocks way up here. A lot of people were buying over here, buying over here, buying over here. And now this level is down to 25, almost 26%. So a lot of people trapped in position. So what does that mean? That means when the market rallies, these people are going to look to get out as close as they can to break even. We've all done it. It's not a great thing to do. It's not a disciplined thing to do, but we've all done it, I'm sure. So let's look at Warden Series T2109, and this is percentage of New York Stock Exchange stocks that are trading one channel above their 200-day price moving average, and it's related to the spiders over here. And if you look at it again on a very long-term basis, you can see fewer and fewer stocks have been able to stay above one channel above that 200-day price moving average, which is a very, very popular average, and it's a very long-term average. So we can see that level went from 65-70% at the beginning of the year. This is when I started talking about, I think this market's in trouble, back in late December, and now it's down to 23%. So we went from 70% to 23%. Meanwhile, the market has rallied. The spiders here going from somewhere around 45 in that area to 65. So what that's telling us is this market is becoming very thin. The support, the number of stocks that are going up to to raise the level of the S&P and the Nasdaq and all that, they're becoming less and less and less. So it's a thin market. It's a dangerous time, in my opinion, to be long a big position. Treasuries. And this is an ETF, again, Lehman 7 to 10 year Treasury bond ETF. And basically what we're seeing in Treasuries is a huge rally in Treasuries. There's a flight to quality, so to speak, or a flight to safety. People are getting out of stocks, they're putting their money into Treasuries. And what happens when people get out of stocks and put their money into Treasuries? Well, very simple, and I'm going to see if I can find that. I might not be able to find it, but simply the yield goes down, and the value of the bond goes up. The yield that you're paid goes down because it's a supply and demand issue, quite obviously. Let's look at, let me get rid of this comparison symbol here. We don't need it anymore. And let's take a look at oil. This is another issue in the market that's causing concern. This is light sweet crude oil index, and you can see that oil is up here around $96 a barrel, from $70 in August. So that is a huge price appreciation. Over 25% appreciation in 1, 2, 3 months or so. Where is the top in oil? Who knows? Who knows? But it's a very big problem in my opinion. People make arguments that oil is, if you adjust it for inflation, it's not much higher now than it has been in the past, and blah 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 blah. A lot of things have changed. We weren't driving mega SUVs in 1980, or 1970. It wasn't a status symbol to have the biggest SUV you could find, and now it is. So it's a problem. It's a real problem, I think, with oil. And we're going to look at a couple other things related to that as we move along here, which we're going to do right now. We're going to take a look at a gold index, XGLD, and again, another flight to quality. You could see the gold index at 650 back in August, now up to 831. Again, a huge, 30+%, or around 30%, I think, increase there in the price of gold. And silver's rallied as well. And generally speaking, let me pull up commodities. Generally speaking, I think this is it. Yeah, generally speaking, commodities have been very strong. You can see the commodity index here at 25 back in August, up to 31. Again, another huge rally in commodities. Let's see what that was. Okay, we got 23%. So in 3 months, so a huge rally in commodities. So this could drive inflation. This could be part of the reason the Fed is sitting on its hands right now. Let's take a look at the SOX. See if I get this right. Here's the semiconductor index. And at this point, you know what? I want to go back to my candlesticks. So here's the SOX, and they just have not really been performing very well. Head and Shoulders. Let's back up, take a look at that. So the Head and Shoulders there in SOX. Again, a great opportunity to get short right in there on that pullback. Again, another Head and Shoulders type of pattern in here, and again, another great area. Let's do a trend line there. Let's see what a trend line looks like. Let's come in right over here. So again, you can see a really nice entry right there on a short position in semi holders. Is it getting a little bit oversold? It's getting there. We see some volume here. A little volume at a bounce there, a little volume here. This almost looks like a little tweezer bottom. So maybe we're going to see a little bounce in that. We're going to take a look at 3C on this when I get back.